stop. Before you close this video, I need you to think about the last time you got a tax refund. Remember that feeling, that sudden deposit, that number you weren't expecting, that moment where you thought, yes, finally. Maybe you screenshotted it. Maybe you called someone. Maybe you already had a list of things you were going to do with it. Felt good, right? Now, what if I told you that feeling, that excitement, that relief was manufactured? Not accidentally, not coincidentally. Deliberately. You were supposed to feel that way. It was designed to feel that way. And it has been working on millions of people for decades. Because here's the truth nobody puts in the headline. That refund was never theirs to give. It was yours to begin with. Every single dollar taken from your paycheck, month after month, sitting in an account that wasn't yours, earning interest that wasn't yours. And when they finally returned it, you celebrated. That's not a refund. That's the oldest financial trick ever pulled. And almost nobody talks about it. By the end of this video, you will never see that deposit the same way again. And honestly, you'll be a little angry. You should be. Let me explain something that your employer, your government, and your accountant have never sat down and clearly told you. Every time you get paid, your employer takes a chunk of your salary before it even touches your bank account. This is called tax withholding, and on paper, it sounds reasonable. The government needs its share, so they take it up front. But here's where it gets interesting. The amount they take is almost never exact. It's an estimate based on a form you filled out probably years ago, probably without fully understanding what you were doing. And most people, they fill that form out wrong. Not because they're stupid, but because nobody explains it properly. So what happens? They overwithhold. They take more than they should every single month from every single paycheck. And that extra money, your money, sits with the government all year long. Now, here's the part that should make you uncomfortable. When that money isn't in some special account with your name on it, there's no little vault somewhere labeled your refund, safe and waiting. It's just gone into the system, used, moved around. And at the end of the tax year, they calculate what you actually owed, compare it to what they already took, and if they took too much, they send it back. No interest, no compensation for the time they held it, no acknowledgement that this money was yours the entire time, just a deposit, and a you're welcome energy that nobody ever challenged. The average tax refund in the US is around $3,000. In the UK, it's around £1,500. That's not a bonus, that's your own money. Returned late with nothing extra, and somehow you're supposed to be grateful. So now you know what a tax refund actually is. Your money taken early, returned late, with zero interest and zero apology. But here is where it stops being just annoying and starts being genuinely expensive. Because it is not just about the money they held, it is about what that money could have been doing while it was gone. Think about it this way. Every month, an extra $250 leaves your paycheck before you even see it. That is $3,000 over the course of a year. Be quietly disappearing into the system while you budget around whatever is left. And during those 12 months, what happens? Maybe you struggled in October. Maybe you skipped an investment in November because you felt tight. Maybe you put something on a credit card in December because the cash just was not there. All while $3,000 of your own money was sitting somewhere else, doing absolutely nothing for you. And then April comes, the refund hits, and suddenly you feel flush. But here's the trap nobody names out loud. That feeling of abundance in April, it was paid for by 12 months of artificial scarcity. You were not broke last November. You were just separated from your own money. The government did not give you a gift in spring. They returned what was yours after quietly borrowing it all year, interest-free, while you figured out how to make ends meet without it. And the worst part? Most people do not change anything after realizing this. They get the refund, spend it, feel good for a few weeks, and then the cycle starts again in January. Same withholding, same overpayment, same artificial scarcity, same fake bonus in spring, year after year after year. That is not a refund system. That is a loop, and most people never step out of it. All right, so let us do some math, not complicated math, just the kind that makes you stare at the ceiling for a while. The average American gets around $3,000 back every tax season. The average British person gets around 1,500 pounds, and most people treat that money like it just appeared out of nowhere. But we already know it did not appear. It was always yours. So here's the real question nobody asks. What if you had kept it, not spent it, not splurged it, not booked a holiday with it, actually kept it and put it to work every single month instead of handing it to the government interest-free? Let us say you redirected that $250 a month into a basic index fund. Nothing fancy, nothing complicated, just a simple low-cost fund that tracks the market. At average market returns in 10 years, that $250 a month becomes somewhere around $40,000 to $45,000. In 20 years, we're looking at close to $120,000 from money that was already yours, that you were already earning, that was already leaving your paycheck every single month, just going somewhere different. And here is what makes it sting a little more. That $3,000 refund you celebrated in April, the one that felt like a bonus, the one you maybe spent in 2 weeks, if it had been invested every single year for 20 years instead of handed to the government and then blown in spring, it would have been worth more than your car, more than most people have saved in their entire working lives, just from redirecting money that was already yours to begin with. That is not an investment strategy. That is just not giving away what you already own. So if this is all true and the math is this obvious, why does almost nobody change anything? That is the question that actually matters. And the answer is not stupidity. It is not laziness. It is not even ignorance. It is psychology and has been working on all of us for a very long time. There is something called the windfall effect. And it is exactly what it sounds like when money arrives unexpectedly or feels unexpected, feels like a surprise. The brain feels like a surprise. The brain categorizes it as bonus money. And that is exactly how a tax refund feels, even though it should not. You did not win it. You did not find it. You did not get lucky. You just got your own paycheck back 12 months late. But because it arrives in one lump sum, because it shows up after months of not seeing it, because it lands in your account all at once, your brain treats it like a gift, and you spend it like one, too. And here's the uncomfortable part. This is not accidental. The system is not broken. It is working exactly as intended, keeping money out of your hands during the year when you might invest it, and returning it in spring when you are statistically most likely to spend it. New clothes, holidays, home improvements, gadgets, like the economy gets a boost, retailers get a surge, and you get the temporary feeling of being wealthy for about 3 weeks. Before January, this starts the whole thing over again. All right, so here's the part where things actually get useful. Because knowing the problem is one thing, but knowing what to do about it is what actually changes your financial life. And the good news is, the fix is simpler than you think. It starts with something called adjusting your withholding. And before your eyes glaze over, stay with me for just a second, because this is genuinely one of the easiest financial moves most people never make. In the US, your employer has a form called a W-4. In the UK, it works through your tax code. And both of these essentially tell your employer how much to take out of your paycheck every month. And most people filled these out once years ago without really understanding them and never touched them again. That is the problem and also the solution. If you adjust your withholding correctly, you stop overpaying the government every month. Your paycheck gets slightly bigger, and instead of waiting for a lump sum in spring, you keep your own money in real time. Now, the obvious question is, what if I end up owing money at tax time? And that is a fair concern. You want to get this right, not overcorrect and create a new problem. So the move is simple. Speak to your employer's HR department or use the IRS withholding estimator online. If you're in the US, HMRC has a similar tool in the UK. Get the number right, adjust accordingly, and then here's the most important part. Take that extra money hitting your paycheck every month and immediately redirect it, index fund, savings, debt payoff, whatever your priority is. Do not let it disappear into daily spending. That defeats the entire point. Let us talk about the real number, not a feeling, not a theory, an actual cost over an actual lifetime. from an actual decision most people never question. Meet someone who has been working since they were 22, good job, steady income, gets a tax refund every single year, around $3,000, celebrates it every single year, spends it every single year. By the time they hit 45, they have received roughly $69,000 in refunds over their working life. $69,000. And that came from their own paycheck that was always their own money that they handed over interest-free every single year and then spent within weeks of getting back. Now, run the alternative. Same person, same income, same $3,000 a year, but this time they adjusted their withholding, kept that $250 a month, and put it straight into a basic index fund every single month without touching it. By 45, that same money, their money, the money that was always theirs, it would have grown to somewhere between $180,000 and $220,000. That is not an investment strategy. That is not financial genius. That is just not giving the government a free loan and then spending the refund on things you cannot remember buying. The gap between those two numbers, $69,000 spent versus $200,000 built, that is not bad luck. That is not unfair circumstance. That is the cost of one assumption. The assumption that a refund is a reward. It never was. It was your money. The whole time, waiting for you to claim it properly. And the best time to fix this was years ago. But the second best time is right now. Today, before January comes around and the whole cycle starts again. This is Regretomics. See the regret before you sign.